Okay, good afternoon, everybody. I think we'll get going. I think in future we'll have a bit of background music in those awkward minute or so at the beginning of these webinars. But anyway, so without further ado, for those who haven't been on this series of webinars that we run every year before, my name's Matt Hodgson. I'm a partner in the business and lead our Manchester office. I'll be hosting today's presentation. Richard Smith, our head of VAT, will be very much delivering and leading it. Couple of quick housekeeping points. That the first is in terms of questions and your ability to ask those. You're all on mute. That doesn't mean, however, that you cannot ask questions as we go, which there is a Q&A function. So we'll be monitoring those, and Richard will be pausing occasionally throughout the presentation to have a look at those questions, which I'll be feeding into him. And then the final point is if there are sort of too many questions, which we have had on occasion to get through in the hour that we've got, we will circulate answers to those along with the slides and the recording of this presentation after today's presentation. So those are the housekeeping points out the way. Nothing to do with fire escapes, given it's a virtual webinar, so we don't have to talk about those. And without further ado, again, over to you, Richard.
Great, thanks, Matt. Welcome everybody to this seminar. As Matt said, my name is Richard Smith. I'm an associate partner and head of indirect taxes at Claritas. I've been working in the VAT field for longer than I care to remember, but specifically with regards to today's topic and M&A type activity and associated indirect tax issues, I've been working in that field for the last 10 or 12 years. So in terms of the agenda and what we're going to cover today, and to set some context, we'll start off by just talking about the sort of economic landscape and why M&A activity is important to the economy. We'll then kick into some of the tax technical issues around M&A activity, specifically in relation to buy-side VAT recovery on transaction costs, the key issues, challenges from HMRC in the past and continue to be, typical buy-side structuring in relation to what I see in terms of PE-backed acquisition structures. We'll explain the phrase direct, continuous and necessary extension, because it's an important concept when we talk about VAT recovery on transaction costs. Then we'll move on to more general type issues involving holding companies and VAT recovery for those types of entities, especially if they're passive, and we'll cover off stewardship costs as well. And then we'll return actually to M&A and transactions, and we'll look at VAT recovery from the sell side perspective. So if you're a vendor in a transaction. And then finally, as Matt said, there's opportunity to ask questions through the course of the presentation. We'll be stopping and pausing for questions, and also at the end if we don't get round to those. So moving on and setting some context. So here is just a number of sort of press cuttings and sound bites from various publications during 2022. And I think what it shows is that M&A type activity is a pivotal part of the UK economy, and I would include the involvement in private equity in that. Yes, it can be cyclical. Yes, there can be slowdowns and speed ups in relation to sector and types of businesses, etc., ranging from SME type activity, mid-market activity, to the real big global corporates involved in M&A. And impacting factors include things like availability of cash, interest rates, sector regulation, and importantly, consolidation in relation to complementary markets and diversification, where businesses want to expand either into other areas or to new markets or even overseas. So yes, M&A activity is going to be affected by economic and structural environments, but I think it's relevant to say that it's not going away. So what does that lead us to? That leads us to the sort of a couple of the big issues involved in transactions when we look at them from a VAT perspective, and it's mainly centered around the recovery of VAT on transaction costs. So just to revisit some guiding principles around a VAT recovery, and apologies here if this is old ground for some people on the call, but I think it's important as a starting point. That input tax is the VAT that a business will be charged on its business expenditure, and it includes goods and services supplied to the business in the UK, goods that are imported from outside the UK into the UK, and services supplied in the UK which are imported or received from abroad. So all of those three bullets there are where a business is going to incur input tax. And a business can normally reclaim that input tax that it incurs where it relates to supplies that are made that are taxable. And here in the UK, we have 3 taxable VAT rates. It may seem odd that there's a 0 rate and that's classified as taxable, but it is. And also the reduced rate of 5% and the standard rate, which we all know is 20%. There's also an opportunity to reclaim input tax that relates to supplies which a business makes that's outside the scope of VAT, so to a foreign body, but which would be taxable if it were made in the UK. So that's essentially what in VAT parlance is called attribution. So it's the attribution of the input tax to the supplies that you make is the guiding principle around whether or not that VAT is recoverable. And then just talking about the sort of practicalities around reclaiming input tax, once you've established that you have a right to deduct by virtue of the attribution, as mentioned above, then practically a business must have been the recipient of those services and those goods. And that's important when we start to talk about transactions. But it must also hold the requisite evidence for the expenditure. So that is usually in the form of a valid VAT invoice. And it also must have paid the VAT that it incurs. So just turning to transactions now and VAT recovery on transaction costs from an acquirer's perspective, from a buyer's perspective. It's fair to say that deal costs and VAT recovery environment has been somewhat plagued by uncertainty, which has been most unhelpful in the period up to about 2017, when HMRC seemed to get their sort of eggs in a row and issue more clear and more definitive guidance. You know, back before 2017, it was a real dog's dinner actually, and taxpayers were constantly in dispute and being challenged by HMRC in terms of what they could and what they couldn't recover in relation to transaction costs. So despite, I would say that despite the clearer guidance that came out from HMRC in 2017, it still remains a hot topic for them. They still look for opportunities to see where VAT has been recovered erroneously and not according to their official guidance. So it's definitely on their radar still. But the 2 key principles that came out of the review in 2017, which is effectively led by case law. There's no definitive VAT statute around VAT recovery on transaction costs. It's been left to cases to effectively decide the guiding principles. But the 2 key cases that sort of drove these 2 basic principles that HMRC have in their guidance was the 2014 Court of Appeal case in Air Tours, and again a Court of Appeal decision in 2013 in relation to the BAA case. And the guiding principles there that came out from those cases is the to whom and for what purpose test. Now, the to whom test is which entity is seeking to recover the VAT, and is it the actual recipient of those services? And just to further highlight that in terms of the case, the Air Tours case onto the to whom test, there Air Tours in financial difficulty back in 2013, engaged with PwC to undertake viability studies in relation to further funding. And there were tripartite contracts between itself, PwC and the banks. And clearly, it sought to recover the VAT, and they lost that case at the Court of Appeal because they weren't the recipient of the supplies, the banks were. So that's important. as is the for what purpose test and the BAA case in 2013 that led to HMRC Business Brief 3214. And the key concept there is that at the time the VAT is incurred, in that case of BAA, there was no intention to make any form of taxable supplies. There was no direct and immediate link between the costs consumed and the activity of the entity looking to recover the costs. So those are important concepts that we continually sort of work with in order to review VAT recovery on deal fees. And then just final bullet point there in terms of holding companies, and passive shareholding in HMRC's eyes is not seen as an economic activity that gives rise to VAT recovery. So if you have a holding company, and I know we'll come on to that in due course, but holding company that does nothing more than receive a dividend from its trading subsidiaries, or have a strategy to deal with hostile takeover, etc., but does nothing else, that is seen to be a passive shareholding, not giving rise to VAT recovery in that holding company. Just turning to sort of structuring considerations, what to consider, in the lead up to a transaction. Your holding company in a group or an entity is looking to acquire a target. What sort of things to look out for, what sort of things to think about in those early stages. Is to get a feel really of what fees are expected. So in terms of the funds flow, where are your costs going to come from? Who have you appointed? Who have you engaged with in relation to the transaction? And maybe pick out, what's likely to be VATable and what's likely to be exempt. Clearly, if you're not going to incur VAT at source from your professional advisor, then there's no issue around VAT recovery. So, there is mileage, I think, in looking at some of the exempt costs that you may incur. For example, corporate finance fees, where corporate financiers are sort of taking the lead on the transaction and have been engaged to find a buyer from the outset. And financial institutions, in terms of funding the acquisition and arrangement fees, they are likely to be exempt as well. It's also important to find out where the costs will be incurred. So look at your deal structure, look at the acquisition entities involved, review supplier engagement letters to make sure that they are with the right entity, and if they are not, is it possible to novate them pre-completion to ensure your ducks in a row to be able to be in the best position to recover the VAT. Look out for and be cognizant of the fact that some supplies are not likely to be recoverable in the holdco or in the acquisition vehicle. It's often the case that third parties engage with suppliers but request or ask that you recover the VAT. What has been agreed commercially between the parties in terms of settlement and engagement and so on. And then look at the transaction steps. Are we looking at a partially exempt VAT group? Is the target partially exempt? Look at the transaction steps to see if even if VAT recovery was permissible because you fulfill the to whom or for what purpose tests. Look at the coalface as to whether or not VAT can actually be claimed in full. Is it a fully taxable acquiring vehicle or VAT group, or is it partially exempt? But just moving on now to a diagrammatical illustration of the sorts of structures that I see a lot of, especially where the acquisition is backed by private equity. So again, coming back to this point about being consistent in terms of which entity the advisors engage with. Typically, I see it's the company that's going to make the acquisition, but it's not always the case. So have a think about that. What we've got here in terms of the illustration is, a typical acquisition structure. So group and holdco at the top level. Holdco can either be an existing holdco, it could be a new bidco inserted by private equity investors, and atypically it's the holdco that will engage with and pay the transaction costs. There might be a couple of finance intermediate holdcos in the stack, in the structure for funding purposes, but atypically, as I say, that holdco will engage and pay the deal costs. And is it possible there to form a VAT group between holdco and targetco, in order to in order to sort of pave the way towards having a robust VAT recovery arrangement, putting some substance into holdco or bidco in the form of either management services down to target group or financing, so downstream loans, and then it's important to find to establish whether or not those downstream loans are made within a VAT group, in which case they can be interest free because they are disregarded supplies because they're supplies within a VAT group. If you're not putting holdco and target into a VAT group, and holdco or bidco registers for VAT on a singular basis, then it's important that holdco and bidco don't, in terms of the lending point, don't have interest-bearing loans, because that would be an exempt supply and it would restrict recovery, because holdco or bidco would then become partly exempt if it's also providing taxable management services. So again, just a few things there to look out for. I'll stop there and pause for questions. I think one has come through on the chat box, but Matt, do you want to sort of manage the question? Any questions?
Yeah, hi Richard. I've answered the one that came in the Q&A. We've had one sent to Talia directly on email as well. So I think just before that, I would just say, listening to what you're saying here, very much so. I think what you and I see a lot is a lot of leakage typically on these sorts of acquisition structures, where there hasn't been that kind of forethought and planning around the various VAT flows in relation to acquisition structures. So it's unfortunately something we do see time and time again, hence why we try and get Richard involved as early as possible when it comes, in any M&A type activity. But the question that's come through to Talia is, has HMRC's delay in processing VAT group applications, changes to VAT groups, that sort of thing, impacted VAT efficient structuring advice in any way?
Yeah, it's a really, really good question, that, Matt, actually, and it's something that I've seen on a number of occasions where, atypically, as you move to, in terms of the planning on these acquisition structures, you look to form that VAT group, because it's just easier. Either if there's an existing VAT group, to add the new bidco to it, it fulfills the ownership criteria as long as the bidco is established in the UK and it will only own the target, which clearly it will do. So the criteria is there to VAT group straight away. But of course, the fly in the ointment is, post pandemic, HMRC's resourcing and processing the VAT group additions or formations. And when cash is tight and the new structure wants to recover the deal fees, if they're significant enough, relatively quickly, they don't want to be sitting on a sort of creditor for ages, then it may be simpler. And I've had experience of doing this, of singularly registering NewCo, BidCo, especially if it's going to put the management services agreement in place from the completion date, putting one invoice through in relation to the management services, and then recovering all the VAT on the deal fees. And that just seems it seemed on a couple of transactions that I was involved in that was the quickest, easiest way. HMRC were returning single VAT registration applications a lot quicker than they were VAT group changes. And so you go down that route first, and you can always add it to the VAT group or form the VAT group at a later point in time when the delays have subsided. So yeah, it's a really good point, and hopefully I've answered that appropriately.
Thanks, Richard. Yeah, that's it for now.
Thank you. We'll move on. Again, just some phraseology sort of definitions here. HMRC, in their guidance back in 2017, in their internal VAT manuals, references there on the screen, talk about having a direct, continuous and necessary extension. And I think this really relates to the point around, if I move that on, oh, we've got it in bits here, primarily relates to examples where a business, so this is not private equity backed, this is just a standalone group, or maybe even a trading company that wants to buy a complementary business, with the potential to either increase its market share in the activity or to achieve some form of economies of scale, etc. And primarily it relates to scenarios where it will immediately join an existing VAT group. And there, if HMRC accept that you don't necessarily need to put in a management services agreement, you don't necessarily need to think about, intercompany lending to give some substance to Bidco to recover the VAT. If the shareholding is to, as it says in the quotation there, if it's to acquire a company as a direct and continuous and necessary extension of the activities in the holding company itself as part of the VAT group as a single taxable person, the VAT may be recovered in full without needing to sort of plan any further. It is largely untested where you don't have an existing UK VAT group. You're going to, you have, or you're going to add a new co to, or you've got an existing holdco in, or where you're acquiring non-UK entities. So that's sort of uncharted territory at the minute. Right, let's sort of turn our attention to passive holding companies, and we're sort of straying outside of the typical sort of M&A type transactions here, whether it's buy or sell. We're just talking about holding companies that exist within corporate groups and who incur costs. So key point here is that just because a holding company is a member of a VAT group with trading subsidiaries that are fully taxable, so only ever charge VAT on their supplies, can recover VAT in full, it does not necessarily mean or entitle that holding company to be able to recover VAT on costs. So the principles we've just talked about in terms of things like the to whom tests and the for what purpose tests extend to holding companies outside of the M&A field. And we do continue to see challenges from HMRC in this area, attacks on corporate groups that have holding companies that are incurring costs that are within fully taxable VAT groups. And I think the important thing to take away from this slide really is the third bullet really is, to defend a challenge from HMRC on this, it's important to distinguish what type of costs are being received and what type of supplies are being received by the holding company. Is it for its own activities, or is it for the purposes of the VAT group as a whole? And I think this links and segues nicely into the final bullet point there, that is, if the holding company is, for convenience, on many occasions, is receiving and paying for costs that can be determined to be stewardship type costs, so things that relate to the activities of the group as a whole, like a group audit fee or regulatory fees or strategic fees in relation to the future strategy of the group, then HMRC allow VAT recovery on that basis. Just want to cover off very quickly just an extra post-Brexit change that does have an impact on holding companies' entitlement to VAT recovery. So this relates to the place of supply effectively on the SPIV services that relate to B2C type supplies. Now, C in this context is a bit of a misnomer, because there's an extra condition around what constitutes consumers from a VAT perspective. So just starting at the top, post-Brexit, the general rule for B2C supplies, pre-Brexit, B2C supplies of services is that the place of supplies will be where the supplier belongs. And therefore, if your service provider belongs in the UK, then for B2C supplies, they will charge you UK VAT. However, post-Brexit, new legislation or existing legislation was tweaked, which means that where a UK supplier provides services of a certain nature to individuals, that's the traditional B2C type definition, but also entities that are not in business. So this will include, your passive holding company type entities. Outside of the UK, then the place of supply is where the customer belongs. So the VAT is shifted to where the customer belongs. And if your passive holding company is, or you have a passive holding company that's based overseas, then routing services such as lawyers and accountants that have been working on a transaction for you to that passive holding company would mean that no UK VAT is incurred. Now, it may be that there's local VAT to account for in the passive holding company, but if it's a B2C supply, there definitely won't be UK VAT that's chargeable. And the implication there is that where traditionally you may have had UK VAT being charged to a holding company in the UK VAT, and that entity isn't doing much at all, it's effectively passive, then supply would be treated to subject to VAT, and the passive holding company would have a problem recovering that VAT. So potentially here, if we can plan to route, and again, it's getting in early and making sure engagement letters are with the right entities and the right entities are paying for those services. If we can route them to passive EU holding companies, it may well reduce any VAT costs. And as you said on the last sort of bullet, a reduction in irrecoverable UK VAT for UK-based holdcos. Okay, so just moving to sell side costs. So we've talked about buy side costs, and I guess from a sell side perspective, the sort of default position around VAT recovery on deal fees, where you are the vendor, where you are selling shares, is that there's no recovery. And that's essentially because the VAT treatment of a share sale is exempt. That's enshrined in UK domestic legislation. It's VAT exempt. And going back to the principles of attribution, where you incur costs that relate to an exempt supply, atypically there is no VAT recovery permissible. So that's a sort of default case. That's a sort of perception that most sort of tax practitioners may have, that as part of the deal flow, we're not entitled to recovery because we're disposing of shares. Let's take a hit on the VAT. Now, that's not necessarily the case. So where it's possible to argue that the services that have been commissioned have a broader business purpose and support the selling group's taxable business activities, there may be an opportunity to agree something with HMRC that some VAT recovery is permissible, or even all of the VAT is permissible. We'll talk about abort fees in due course. Watch out for costs that are going to be received by management or exiting shareholders in their personal, for their personal tax reasons. Unlikely to be recoverable if vendor entity is incurring those costs, and that's sort of mirrored on the buy side type costs as well. So there's no real departure from that. Is the entity seeking VAT recovery a taxable person for VAT purposes? That that just means, is it registered and is it carrying out taxable supplies? Again, you need to think that one through again with who is engaging for the sell side costs. But we've seen a gradual, I think, over the years, softening in HMRC's view around sell side costs and VAT recovery. And I think they are warming to and will reference items such as vendor due diligence costs being potentially VAT recoverable. They'll look at it on a case-by-case basis, but I think it's important, I guess, to take away from this slide is that don't immediately just write off the VAT. If there is a broader purpose behind the transaction, then it definitely may be worth looking at and on a deal by deal basis effectively. There's no specific HMRC guidance that we can lift from. Certainly isn't in relation to aborted deals. So this is where, you know, a deal doesn't get off, well, it doesn't complete. It might just get off the ground in terms of all the due diligence, but for one reason or another, there is no completion. But equally, again, the same sort of principles would apply on aborted deals. So why are you incurring these costs? For what purpose? Can it be argued that it's for other reasons other than just to sell the company? And we'll come on to some examples of that, I think, on the next slide, actually.
Richard, as
Yeah.
we have had another question as you've been talking there. So
Okay, great.
it's something I see on occasion when reviewing tax computations, typically from other advisors, other accountants, you know, who've done the year of the acquisition and I guess failed to recover any VAT to an extent. So it's related to that. And the question is, so is there scope to revisit share sale transactions where the default position has been to write off as an absolute cost VAT incurred on advisors' costs?
I think it is. I think if that's the base case, if you know that, you know, as part of that transaction, you know, there was, you know, 15 service providers, and we took the view not to include the VAT we incurred on their costs through our VAT returns, and the funds flow, you know, sort of recognise that, then, you know, we have a 4-year statute of limitation periods in VAT, so we can go back to revisit these types of transactions for up to 4 years. You know, it will still be important to look at the sort of structure around the sale. You know, which advisors we engage with, what did their engagement letters look like, did we receive invoices, and so on. And even if, you know, taxpayers have to give up some of that VAT on the basis that, you know, the costs were clearly incurred after the mandate to sell the company had passed, and it relates to, let's say, for example, legal fees on preparing the deed of sale, then clearly that, you know, it's going to be very difficult to get the VAT back on those types of costs. But if it's initial due diligence, you know, and that has relevance and can be utilized by the selling company for other reasons, you know, maybe for financing, maybe for you know, disposing of a company down the line where the disposal isn't going to be, you know, by way of share, it's going to be by way of asset. So is it going to be a transfer of going concern? So those sorts of things come into play, and, you know, even if you get partial recovery, then it's better than nothing. So definitely recommend revisiting if, as you say, there's been a decision taken just to not recover anything at all.
That's great. Thanks, Richard.
Okay. And I think this is the final slide, actually, and this is I think this is just a way of showing that there is some mileage to push the envelope a little bit around VAT recovery on disposals, i.e. share sales. And I'm going to reference a couple of cases, and they almost contradict each other. And the most recent case, the Hotel Latour case, whether it can be considered rogue or not, I think is interesting in terms of perhaps the direction of travel around, you know, this default position that nothing was ever, or nothing can ever be recovered on share sale type supplies. And just by way of background, the Hotel Latour case was decided by the first tier tribunal in December 2021. And effectively what happened there is that in order to fund the acquisition and development of a new hotel, Hotel Latour decided to sell an existing wholly owned subsidiary. In the diagram there, it's called HLT Birmingham, as well as existing debt facilities that were housed in the group. So they needed this consideration of 13.5 million from the acquirer in order to fund, you know, a future acquisition. You know, and partly influenced by the Supreme Court decision in Frank A. Smart, and previous ECJ decisions, particular ABSKF, the tribunal judge supported the view that providing the purpose of this transaction was to generate cash to fund the general overheads or specific taxable activities. And of course, the operation of a hotel is taxable, and that the costs do not form a cost component of the selling price of the shares, then the VAT treatment of the sale, yes, the sale of shares would be exempt, but it does not prevent VAT recovery. So it's almost endorsing this sort of look-through principle as to the purpose of why you're undertaking the transactions. And what it meant in this particular case is that the 70 or 80K's worth of VAT that was incurred by the selling entity on legal fees associated with the transaction were recoverable in full. So perhaps a rogue decision. Interesting in that HMRC have not come out directly and responded on the case, and I think would revert to normal principles as in the normal course of sort of looking at these types of arrangements. But it just shows you the potential to have that debate with HMRC to see what is possible. And again, similar approaches on sell side transactions. What to do it early, look at the costs you're going to incur in the run up to the transaction. Do those costs have a broader business purpose? Were those costs associated with an abortive transaction? And revisit. I've just missed out referencing Travelodge there. That was at the other end where Travelodge, in the course of a transaction, a sale and leaseback, I think it involved, lots of hotel properties, but a sale and leaseback type transaction. Firstly and foremost, some of these transactions, some of these sale and leasebacks were of assets. So there was TOGCs in play, transfers of going concerns, but some were housed in special purpose vehicles, and the shares of those were sold, and they tried to deduct the input tax on that sale. And in that case, the first tier tribunal went the other way. And admittedly, it was in 2013, and Hotel Latour was very recent. But in Travelodge, the appellant was trying to argue that the share sales were akin to a TOGC, and that failed. And then they tried to argue that the share sale was also akin to a rights issue or a share issue, which there is a difference in VAT treatment of. One is share sales are exempt, share issues are outside the scope. And so in both instances, the arguments that it was either a TOGC or it was a rights issue or akin to, and therefore not an economic activity, and therefore the input tax failed to be attributed as based on the underlying supplies nature of the trade, failed. So in that case, VAT recovery was denied. So I'm just, it's just evidence really of the departure and the fact that it's still uncertain and it's still worth pursuing, as we've already said, if you have written those VAT costs off on a share sale, to see if it's possible to recover at least part. So that's about it. I think we're up to sort of 40 minutes or so, and you have an opportunity to ask further questions.
Thanks, Richard. I think before we wrap up, we've got another question that's come directly through to Talia, and it kind of is, well, it's a good one actually. It's a summary of everything you've talked over. What, in your view, is the biggest pitfall or the most common error when reviewing a PE-backed acquisition structure, and whether VAT recovery has been factored into the funds flow?
Yeah, very good. I probably could talk at some length of this, but I'll try and be brief. Actually, I think, with transactions, they're sort of time sensitive, critical, lots of things to think about. You've probably got, various due diligence projects going on, whether it's commercial, legal, insurance, and tax is just one of those. So, lots of things going on, very stressful up until in terms of the run up to the completion, and that sort of gets ignored a little bit. So I guess what I sometimes see, which is sort of the nightmare scenario, is that, you know, you've got a PE-backed acquisition, you've got your structure all in place, and with a bit of simple planning here and there, you can effectively get to a position where VAT recovery is on the transaction fees that can be chunky, is fairly robust, and, you know, blessed by HMRC, and you know, it's not going to represent a cost to you, but it can just get shoved to the bottom of the pile and forgotten about, and then you're sort of 6 months post transaction completion, and the question gets raised, oh, what did we do on VAT recovery? And either it's gone to the wrong place and been recovered, which is an error because the planning hasn't been implemented, or it's been forgotten about, and now it's very difficult to unravel that and sort of do anything about it, really. So getting in early is the key thing. Planning for it early is the key thing. Sometimes, so the second part to my answer, I suppose, is you may have done all of that and put the arrangements in place. So with a PE-backed type structure, you'll have, you know, bidco or newco registered for VAT, but it needs economic substance in order to, one to register, but two, have, you know, this direct and immediate link in which to recover the VAT on the costs. And sometimes, you know, the management services agreement hasn't been drafted, hasn't been executed, and then you're in a difficult position because you're sort of working backwards. And there were a couple of cases where that happened, and VAT recovery was denied because the actual management services agreement was put in after completion as a sort of afterthought 12 months down the line, tried to implement it retrospectively. You know, the paperwork wasn't fantastic, and therefore HMRC successfully challenged and said that it was artificial, and, you know, if they would have done this at a different time in a different way, they would have got VAT recovery, but it was an afterthought. So those are the two key things: get in early, plan early, and, you know, once you know what you're doing, make sure the sort of I's are dotted and the T's are crossed in terms of implementation, and your MSA is right, and your registrations are all in place, and so on.
That's great, Richard. Well, that's, I know we have had another question through, actually. I don't know if you can see these or not. It says, at which point of a transaction should you begin to consider the VAT impact?
When either your accountants or your, you know, people responsible for the funds flow have put in a line for VAT. So, you know, whether it's recoverable or not recoverable, and then start to impact it. I think if you could get in even earlier, so when you're starting to engage with third-party service providers, that, you know, you've thought about VAT, and that, you know, is there, you know, maybe bidco isn't set up yet, or the ultimate sort of bearer of the cost isn't formed yet, but there's a possibility for novation if possible, if that helps the VAT position as well. So as early as possible, as early as possible, you know, information memorandums phase, or, you know, whether you're looking at a potential sale.
Okay, that's great. Well, I think, we had another one through. Every time I say there isn't going to be another one, we get another one. No, this is the same one, sorry, that is still open. So we've answered that. Right, Richard, thank you very much. I think we've obviously finished a little bit early there, but it was an extremely sort of concise, comprehensive, and very relevant run through of you know, VAT when it comes to acquisition structures, which, as you and I well know, comes up pretty much every single time that we work on a transaction together, and tends to be either an area, as we said, that's either overlooked or is just incredibly complex. So the earlier these things are looked at, the better, because VAT is always on big numbers and can represent a significant leakage, you know, in the context of value and fees that are incurred. So thanks again, Richard. Really appreciate it. As I mentioned to all the listeners at the beginning, thanks for your time. Thanks for spending a bit of time with us today. We'll circulate the slides in the recording and answer any further questions that come through in that same communication when we send it out. So enjoy the rest of the week, everybody. Hope you're getting a bit of sunshine where you are, as we are up in Manchester. See you later.
Thanks.